Jamie Dimon just gave one of the strangest interviews we've seen in a long time. This is a man who historically has never been shy with his words. When he sees a storm coming, he says it's a hurricane. When he thinks markets are overheated, he says brace yourself. When he believes policymakers are asleep at the wheel, he makes it clear. But this time, it was different. Every time the conversation drifted anywhere near government policy, geopolitics, or decisions coming out of Washington, he started sidestepping. Questions that seemed straightforward were met with, "It's not binary." Direct prompts were met with deflection. The interviewer would ask whether something was a good idea, and instead of a yes or no, or even a nuanced answer, he would pivot, reframe, or resist the framing entirely. You could see the tension building. The interviewer clearly wanted sharper commentary. She even called him out at one point, noting how forceful he can be when discussing specific business impacts, yet how cautious he becomes when asked to broadly criticize political decisions. Eventually, after enough pushing, Dimon did start opening up. And when he did, that's when things got interesting. Once you cut through the awkward back and forth, he actually made 5 major points about the U.S. economy: trade policy, the Federal Reserve, credit markets, China, and the structure of growth in America. And those points reveal a lot about how one of the most powerful bankers in the world sees the road ahead. Let's break them down. First, the independence of the Federal Reserve. Dimon was asked about the mounting pressure on the Fed, and specifically about the Department of Justice opening a criminal investigation into Federal Reserve Chair Jerome Powell. This investigation has been widely interpreted by critics as politically motivated, less about wrongdoing and more about creating grounds for removal before Powell's term ends. Dimon's answer was careful but clear. He said everyone he knows, including former President Donald Trump, claims to support an independent Fed, and he emphasized that independence is critical. He openly said he doesn't like lawfare and doesn't like courts being used in ways that could undermine institutions. That's significant. When the CEO of JPMorgan Chase, America's largest bank, signals discomfort with actions that could erode central bank independence, markets listen. Central bank credibility is foundational to financial stability. If investors begin to believe that monetary policy is politically controlled, long-term interest rates rise, volatility increases, and trust erodes. But Dimon added an interesting twist. He argued that the Fed isn't some completely detached, omnipotent decision-maker. In his words, it's often a fast follower. When inflation rises, rates go up. When inflation falls, rates come down. The Fed reacts to conditions rather than inventing them. Historically, interest rate moves have followed economic data trends. That comment subtly reframes the debate. While defending institutional independence, he also downplays the idea that the Fed single-handedly steers the economy. In his view, it formalizes what the market and inflation data already dictate. Still, the bigger question hanging over the conversation is what happens next. If political pressure continues, or if future appointments reshape the tone of the Federal Open Market Committee, will policy remain data-driven, or will it become more directional? That uncertainty matters more than the headlines. Second, the proposed 10% cap on credit card interest rates. This is where Dimon dropped the diplomatic tone entirely. When asked about a proposal to cap credit card interest rates at 10%, he called it an economic disaster. Not bad policy, not misguided, disaster. On the surface, a 10% cap sounds consumer-friendly. Credit card APRs in the U.S. often exceed 20%. Lower rates would seem to relieve millions of households. But Dimon's argument wasn't about bank profits. He explicitly said his institution would survive. His concern was credit availability. Credit card pricing reflects risk. Defaults, fraud, operational costs, capital requirements, these all get built into the interest rate. If you artificially cap rates below the level required to compensate for that risk, lenders pull back. According to Dimon, the result wouldn't be cheaper credit. It would be dramatically less credit. He estimated as much as 80% of the credit card market could disappear under a hard cap like that. Think about that implication. For many Americans, credit cards aren't luxuries. They are emergency funding, they smooth income volatility. They cover medical bills, car repairs, and rent gaps. If banks can't price for risk, they simply won't lend to higher-risk borrowers. The people hurt most wouldn't be Wall Street. They would be consumers who suddenly find themselves cut off. Dimon even suggested an experimental approach, testing the cap in a couple of states to observe the outcome. His confidence was clear. He believes the second-order effects would be severe, and that critics of pricing mechanisms would quickly see the unintended consequences. This is classic economic tension. Price controls can appear compassionate, but markets don't vanish when you legislate them. They distort. Third, tariffs and trade policy. When asked whether tariffs are good or bad, Dimon refused to give a binary answer. He argued that trade policy has multiple layers, and tariffs are tools, not moral positions. He outlined two major justifications. The first is national security. Certain industries, rare earth minerals, advanced semiconductors, critical pharmaceuticals, are strategically essential. Over-reliance on foreign supply chains creates vulnerability. China, for example, dominates rare earth refining. Taiwan produces the majority of advanced semiconductor chips used by companies like Apple and Nvidia. In these cases, Dimon argued, tariffs or quotas may be justified if they help build domestic capacity. Even if it's more expensive, redundancy can be worth the cost. The second justification is unfair trade. If a country heavily subsidizes industries, electric vehicles, batteries, steel, it can undercut global competitors. Domestic producers then compete against government-backed pricing power. In that scenario, countermeasures may be defensive rather than protectionist. But Dimon also made clear he is not a tariff guy in general. He sees them as blunt instruments. Used narrowly and strategically, they may serve a purpose. Used broadly and ideologically, they can inflict collateral damage. His disagreement with Trump's general enthusiasm for tariffs was subtle but unmistakable. Fourth, China versus the United States. The narrative that China is overtaking America economically is common in media cycles. Dimon pushed back. He pointed to GDP per capita differences, alliance networks, military positioning, and capital market depth. The U.S., in his view, still has the most dynamic and prosperous economy in the world. China has made enormous strides, but structurally, the U.S. maintains advantages in innovation ecosystems, financial markets, military alliances, and demographic flexibility. Yes, trade tensions may create openings for China to strengthen alternative partnerships. Yes, friction can shift global alignments. But Dimon doesn't see a near-term reversal of global economic leadership. He sees competition, not collapse. And finally, fifth, the state of the U.S. economy itself. Here's where the old Jamie Dimon reappeared. He described the economy as hugely resilient and in pretty good shape. He cited fiscal stimulus, regulatory adjustments, mortgage activity, and animal spirits returning to markets. Despite media narratives of fragility, he sees strength. But he also believes policy could do more to make growth inclusive. One of his most striking proposals was to expand and simplify income support for low-wage workers. He suggested effectively doubling certain income credits and delivering direct negative tax payments to working Americans, without bureaucratic layers dictating how funds must be spent. In his view, giving lower-income workers direct purchasing power would stimulate local economies organically. Instead of routing funds through layers of programs, distribute them directly. When asked whether taxes would need to rise to fund this, he suggested growth could offset much of the cost. Even if minor increases were required, he implied the design matters more than the tax headline. Then he pivoted to criticism of Washington itself. He described a system saturated with lobbying groups, special interests, and bill amendments that dilute original intentions. He referenced large spending initiatives that begin with strong strategic goals but get overloaded with add-ons and political compromises. His frustration was visible, not with capitalism, not with markets, but with inefficiency. The takeaway from the entire interview wasn't that Dimon thinks America is broken. It was that he thinks America is strong, but poorly optimized. He defended institutional independence. He warned against blunt policy experiments. He supported strategic trade protection when justified. He dismissed alarmism about China, and he argued for more direct economic empowerment for workers. The odd energy of the interview, the deflections, the careful wording likely reflects the environment we're in. CEOs operate in a climate where any comment can trigger political backlash, shareholder reactions, or social media storms. But once he settled in, his worldview became clear. He believes in growth. He believes in competitive strength. He believes in institutional stability. And he believes policy should be pragmatic, not ideological. Strip away the awkward pauses and tension, and that's the real story. In a world obsessed with dramatic narratives, collapse, takeover, crisis, Jamie Dimon's core message was almost boringly steady. The USZ economy is resilient. The system works imperfectly, and the biggest risks come not from markets alone, but from how we choose to manage them.